remarks from a very special guest. Richard Cordray serves as the Chief Operating Officer for FSA, Federal Student Aid. He's also someone who holds a very special place in American history, having served as the very first director of the Consumer Financial Protection Bureau. The Bureau is the first and only federal agency tasked with protecting individual consumers from financial harm. And as director of the CFPB, Richard Cordray made protecting student loan borrowers a priority in consumer protection policies and regulations. We are very fortunate to have him in a position at FSA where he can continue to advocate on behalf of student loan borrowers. He and his team work tirelessly every day to strengthen policies to ease student debt. It is my honor and my pleasure to introduce, even though I will always call him director, he is Chief Richard Cordray from FSA.
Thank you, Beverly, for that all too kind introduction and for your longstanding efforts to make our financial marketplace more equitable, which I have seen up close and personal now for a number of years. As Bev mentioned, I'm Richard Cordray, Chief Operating Officer of Federal Student Aid, and we want to say special thanks here to New Jersey Citizen Action and New Jersey Higher Education Student Assistance Authority for hosting this event and helping to bring this important information to New Jersey residents. I also want to thank New Jersey Citizen Action for their heroic work in support of New Jersey's Borrower Bill of Rights and their work to promote a safer student loan market. It has made a real difference. I am excited to talk about this latest effort to make student loans more affordable. It is the newest repayment plan known as the Saving on a Valuable Education, or SAVE plan. As you all well know, federal student aid is extremely important to deliver the benefits of higher education to more people in this country. This matters to individual students, it matters to their families, to our communities, and to our nation's future. Over the years, the federal programs to help Americans finance higher education have made an incredibly important difference to them and to building our future, so that now we have actually more than 45 million borrowers who carry some amount of student loan debt that they use to help finance their education. Some of you in this meeting and many others you know may be paying down federal student loans, but have not yet taken advantage of our most affordable payment option. For many, the SAVE plan may be just the option you need. At different times, the department has offered various income-driven repayment plans. They're known as IDR plans for short, and they're designed to help ease the financial burden of federal student loans. The newest IDR plan, known as the SAVE plan, launched last August, and it's designed to offer the lowest monthly payments yet among all the IDR plans for most borrowers. In particular, the SAVE plan typically offers the most beneficial repayment terms for low and middle income earners, for public service workers, for community college graduates, and for those who originally borrowed $12,000 or less in student loans. The SAVE plan also affords another important benefit. Those making their required payments do not have their loan balance increase from unpaid interest. As long as you keep up with your monthly payments, which can be as low as $0 per month, that's pretty affordable, the government covers the cost of any leftover monthly interest that your monthly payment does not cover. The SAVE plan thus protects borrowers from something that has hurt a lot of borrowers in the past, runaway interest that can balloon their balances far beyond the amount of the loans they originally took out. Another benefit of the SAVE plan provides early loan forgiveness for borrowers who originally took out $12,000 or less in student loans and have been in repayment for as little as 10 years. For every additional $1,000 they originally borrowed above $12,000 up to $21,000, borrowers with undergraduate loans can still receive full forgiveness after an additional year of payment. Some borrowers have already signed up for the SAVE plan and received this early forgiveness. Just last month, President Biden announced the approval of $1.2 billion in early loan forgiveness, wiping out the debt for almost 153,000 borrowers currently enrolled in the SAVE plan. Notably, the early forgiveness benefit of SAVE was originally planned to go into effect in July, but we implemented it early in February months ahead of schedule to deliver more student loan forgiveness to borrowers. We recently emailed many thousands of borrowers who can become eligible for automatic early forgiveness simply by signing up for the SAVE plan, and we expect to continue these outreach efforts. More generally, we've been aggressively promoting the SAVE plan, and these efforts are paying off. At this point, more than 7.5 million borrowers are now enrolled in SAVE to get a lower monthly payment, and in fact, a majority of those, 4.3 million, enrolled in SAVE now have qualified for a $0 monthly payment. Moving forward, the department expects to implement the remaining benefits of the SAVE plan in July, which will further reduce monthly payments from 10% of a borrower's discretionary income to just 5% for those with undergraduate loans, among other benefits. Borrowers who meet the eligibility criteria for forgiveness under the SAVE plan will have their loans automatically forgiven with no action needed on their part, and the department will continue to identify and discharge the loans on a regular basis. Additionally, if a borrower applies for an IDR plan, including SAVE, on studentaid.gov and agrees to securely share their tax information, then their IDR plan will automatically be recertified the next time recertification is due with no lapse. Given all these important features, if you're a federal student loan borrower, check out the SAVE plan at studentaid.gov/save. That's studentaid.gov/save, and consider signing up immediately. To our state partners, advocacy organizations, and other stakeholders, help us spread the word far and wide about how many borrowers can get more affordable monthly payments and loan forgiveness through the SAVE plan. The Biden-Harris administration is sending a resounding message to borrowers. Federal student loans should enable you to achieve your educational dreams, not become a burden, and the SAVE plan is reaffirming that priority. We'll now hear from Margo Chaly, the Executive Director of the New Jersey Higher Education Student Assistance Authority, to hear about some state-specific programs. Thank you. Margo?
Thank you very much, Chief Cordray, and good evening or afternoon to everyone who's joining us today. I am here on behalf of the Higher Education Student Assistance Authority. No one needs to remember that full name. You will be able to refer to us as HESAA. I have some materials to share with all of you this evening. HESAA is the New Jersey state agency that administers financial aid if you have need and you are attending college in New Jersey. And we're going to talk through all of those programs as well as some additional programs and benefits that we offer here through HESAA. But most importantly, I want everyone to see these contacts. These will be shared in the chat by someone, I'm sure. If you have any questions after this presentation and want to learn more or have specific questions, you can absolutely reach out to our contact center by email or phone. All of the information is provided here. And if you're with an organization, a community-based organization, faith-based organization, maybe you're an employer and looking for financial aid resources for your employees to return to higher education and upskill and pursue another degree, you can also reach out to us, and we're happy to meet you where you are in English or Spanish, virtually or in person, and provide all of the detailed resources. I'm going to touch on them quickly and briefly this evening, but we have a wealth of information also available on our website, HESAA.org. And let's dive into this. I know the theme of this evening is how to manage student loan debt. And one of the priorities we have here at HESAA is to remind folks, if you start saving for college early and often, maybe you're a young person, maybe you have young children, maybe you know young children in your family, you can start putting away money now for that future educational expense and hopefully avoid borrowing or using student loans at all. This is an excellent start. So the state of New Jersey offers the NJ Best College Savings Plan. And it takes as little as $25 to open an account, and you can put away anytime you have the ability to store a little money for a beneficiary to use for a qualified educational expense. And some of the benefits of using the NJ Best program here in New Jersey, if you save for a certain number of years and save a certain threshold of funds, you will also, in addition to having that nest egg of money waiting for you or your family member when they're ready to use it for school, you'll also be eligible for scholarship if you go to school here in New Jersey. So just by saving, you're getting ahead of the game, and you can use those funds at any school or other eligible education expense anywhere in the country. But if you stay here and attend one of our incredible institutions of higher education here in the Garden State, you'll also be eligible for another scholarship, which is more money that you can put to your education without having to borrow at all. Also, right now in New Jersey, we have a dollar-for-dollar matching grant. If you open a new NJ Best account, we will match your first deposit up to $750. You can open an account with $10 and we'll give you $10. You can open an account with $500 and we'll give you $500, all the way up to $750, which is an excellent way to start this piggy bank for you or your loved one who plans to attend college in the future. And there are other eligible expenses for which you can use this saved money. It's also tax-free when you withdraw it to use it for these educational expenses. And if, for example, the intended user of the funds decides not to pursue college, that's okay too. You can also transfer the money to another beneficiary who might be able to benefit from these funds later on. The NJ Best, of course, we think it's the best college savings plan in the country. NJ Best, that should be easy to remember. And of course, all of the information is available on our website. So that is something you can start doing to prepare for college now. Save early and often. Once it's time to apply for college, there is a form everyone's heard about. And if you haven't, I get to tell you about it now. The FAFSA, the free application for federal student aid. You will fill out that application, and by virtue of completing that application, listing that you're a New Jersey resident, we here at HESAA will be able to recognize if you are eligible for state financial funding to attend college here in New Jersey. So you have to be a New Jersey resident and attend college at one of our eligible institutions. And we have more than 50. So whatever you're looking to study, your program or major, you'll have financial aid if you qualify. We have all kinds of programs, from the tuition aid grant and our College Promise program, which is available at community colleges, our 18 community colleges in New Jersey, and our 4-year public institutions with 2 separate programs called the Community College Opportunity Grant and the Garden State Guarantee. And with these 2 programs that we've titled here on the slide, the New Jersey College Promise, you might be eligible for a tuition-free experience. The College Promise is for individuals with adjusted gross incomes. This is your AGI, more letters to remember, your adjusted gross income between $0 and $65,000. You will have 0 tuition to attend a community college or your 3rd and 4th year at a 4-year public school in New Jersey. That's a guarantee. That's a promise. And then we have additional tiers depending on your adjusted gross income at AGI again, whether you earn up to $80,000 or $100,000. There are various tiered guarantees of predictable tuition prices at your community colleges and for your public schools for your third and fourth year here in New Jersey. We also have some merit-based scholarships for if you're in the top of your class in high school. We have the STARS program. We have some other smaller programs with special benefits. For example, if a loved one in your family or a dependent of a loved one who was killed in the line of duty as a law enforcement officer, for example. So we have many, many other programs, and there are too many to list this evening, so we can keep this moving. But please visit our website. If you have any questions, that customer care solution number or email address, our entire team, we have a building full of people ready to help you and answer your questions. Also, it is important to note that if you do not have a Social Security number and you satisfy the criteria on the screen, 3 years in high school, graduate from a New Jersey high school or your equivalent, and you sign an affidavit that you are pursuing citizenship, you are a New Jersey dreamer and you are eligible for financial aid here in New Jersey. So while federal funds would not be available to you, you would have access to state funding in New Jersey due to the New Jersey Dreamer Alternative Financial Aid application, which is our state version of the FAFSA. Now, the reality is, after saving for many years and possibly receiving some of these grants and scholarships that are free money that you do not have to pay back, you may still need to borrow some money to finance your education. And if that's the case, certainly look at your federal loans. If you still have need, a balance you need to cover, please explore the HESAA NJ class loans. These are supplemental loans with lower than other private loan rates. We don't have any late fees, and we have a host of repayment and relief options in case you become off track in your repayment. We'll help you come back, set up a payment plan, and make sure you stay financially healthy with our NJ class loan program. We also have the option to refinance loans. If you currently, you might be on the other side of college listening to this program, and you might have loans that you want to refinance. Please explore the HESAA website and our NJ class refinance or consolidation loan products that might help you have a better, lower monthly payment with a better rate. All kinds of options. And again, our customer care team can walk you through all of your options for which you are eligible. Another way to help pay down student debt are from the student loan redemption programs that we offer here at HESAA. Typically, these programs will be in exchange for service into a certain industry or career track. For example, if you're a public school teacher in New Jersey at one of the eligible public schools teaching in a high need field, if you commit to X number of years of service, we'll help you pay down your student loan debt in exchange for that service. We have programs for New Jersey teachers, folks in STEM related fields, behavioral health care professionals, especially those who have focus on adolescents and youth. There's an extra bonus in paying down beyond in exchange for your service. Again, numerous programs. I could list them all here and give you all the details, but that would be too much to write down or take away. And we clearly outline everything on our website. But at this point, you all know I'm also going to recommend our customer care team and the whole host of individuals who come to work every day hoping to get a phone call from you. That's what they're here to do. Answer your phone calls and answer your emails. Any kind of question. We know these are case specific. you have special details, special circumstances, explain them to us and our team, and we'll walk you through all of your options. Again, as I wrap up, I will leave this contact information up. I've noticed that while I was speaking, there were a handful of questions that came through. I'm sure some of them are for me. As soon as one of the other speakers starts presenting, I will look through those questions and try and get you some answers or ask you to provide some additional information so we can get back to you. Of course, you have this contact information for the HESAA team, customer care at HESAA.org. If you've learned anything tonight, it's that. We will walk you through everything I discussed already to make sure you are saving for college, you are financially prepared to apply for college, what grants and scholarships you might be eligible for, whether you need to fill out the FAFSA or the New Jersey Dreamer application. And there might be some loan programs that will help you manage your debt through school, or if you're already finished with school, help consolidate or refinance your existing loans. And depending on what industry you work in, we might be able to help you pay down your debt with our loan redemption programs that open in various cycles throughout the year. So with that, I am going to kick it back to Bev, is my assignment, who should be coming on to join me shortly. And I will start to look through the questions in the chat as the program continues.
Thank you so much, Margo. It's really helpful, and I appreciate the fact that you talk about how students can avoid debt to begin with, but that of course you have the backup programs available to finance programs at the state level when they need them. And obviously, as you said, we want people to go to the federal loans first, and then come to you guys for whatever else they might need. So thank you so much. You saved us a lot of time. And there were a couple questions for you both in the chat and then Q&A. I just want to remind the participants, it's helpful to us if you could put your questions in the chat feature. You'll find it down at the bottom of the screen there. It's very helpful. Thank you so much, Margo, and congratulations on becoming the new executive director at HESAA. We're going to move on, and I'd like to welcome Rachel Gittleman. Rachel is she is a member of the stakeholder engagement group within the Ombudsman's office at FSA. There is an ombudsman in the Federal Student Aid Office, and the team of the Ombudsman is there to help all of you manage your federal loans. And so Rachel's going to present today on how to best do that and update us on a lot of the programs that Chief Cordray mentioned in his remarks. Rachel?
Thank you so much, Bev, and welcome everyone to our All About Save webinar. First of all, I'd just like to welcome everyone. I am actually from New Jersey originally, so it's really exciting to be with you all this afternoon, or this evening for you all. I'd also like to echo Chief Cordray's thanks to our partners, New Jersey Citizen Action and New Jersey Higher Education Student Assistance Authority. As Bev mentioned, my name is Rachel Gittleman, and I work on the Stakeholder Engagement Group in the Ombudsman's Office for Federal Student Aid. I'm excited to be here today to tell you about the department's most affordable repayment plan yet, and how enrolling in SAVE can help lead to forgiveness. Next slide. So a few logistical reminders before we start. I know we went over some of these, but just to reiterate them, you won't be able to unmute or turn on camera, so feel free to use the Q&A function like Bev mentioned if you have questions, and my colleagues from the Ombudsman's office will be able to help answer those questions. The webinar is also equipped with closed captions, which you can access via the meeting controls toolbar. We are recording the webinar, and I think that's all for logistics. So next slide, please. So we have as everyone has mentioned, we have a really tight agenda today, lots to cover. So we are going to begin with a student loan overview, followed by information about the newest and most affordable income-driven repayment plan that Chief Cordray mentioned earlier, Saving on a Valuable Education, or SAVE. We'll also discuss ways the administration is making it easier to reach forgiveness through the one-time payment count adjustment and public service loan forgiveness programs. Finally, if you have loans in default, you can still access SAVE through a great one-time program called Fresh Start, which we will discuss at the end of today's presentation. Next slide. Okay, so to start, we're going to go over some basics to student loans. We have a few major types of federal student loans. Most student loan borrowers who have federal student loans have direct loans. These are loans directly made by the Department of Education and are serviced by one of 4 contracted companies: AidVantage, Ed Financial, NowNet, and Mohila. Borrowers may also have federal family education loans or FFEL loans. These are older loans that were made before 2010 that were originated by a bank or other financial institution like PNC Bank and insured by the Department of Education. Those loans are either now owned by the Department of Education or owned by commercial entities, managed by commercial entities. And then finally, we have Perkins loans, which are loans made by colleges to students with exceptional financial need. The Perkins program ended in 2017, and the department owns some of these loans now. In addition, FFEL and Perkins loans can be consolidated into a new direct consolidation loan to gain access to SAVE and other forgiveness programs. Now, don't worry, we're going to cover consolidation later on in the program. Now, to find out what type of loan you have, you can check your studentaid.gov dashboard, or you can call 1-800-4-FED-AID, and one of our agents will be able to help you figure that out. Next slide. So as Chief Cordray mentioned, under the Biden administration, the department has approved a record amount of student loan forgiveness. The department has approved almost $138 billion, that's billion with a B, in student loan forgiveness for nearly 3.9 million borrowers. And these numbers were actually updated before the most recent announcement, so they're going to be even higher now. So these numbers, again, going to be higher now, but in general, many borrowers have received forgiveness due to total and permanent disability. Borrowers who were cheated by their schools or saw their schools close, or who were covered by related court settlements have also received forgiveness. And then finally, the most recent cancellations are due to fixes to the income-driven repayment plans and improvements to public service loan forgiveness and added benefits under the SAVE plan. We're going to dig into all 3 of these forgiveness programs today, and I'm so excited to discuss them with all of you. So speaking of income-driven repayment plans, when borrowers first enter into repayment, they are automatically placed on a standard repayment plan. A standard repayment plan allows for fixed payments made up to 10 years or between 10 and 30 years for consolidation loans. Now, for most borrowers, an income-driven repayment plan, or an IDR plan, is going to be a cheaper option. Since IDR plans calculate monthly payments based on income and family size rather than that fixed amount. Plus, when you're on an IDR plan, you will be eligible for forgiveness after 20 or 25 years, depending on the type of loan you have. Now, there are a bunch of different types of IDR plans. First is the Saving on a Valuable Education Plan, or SAVE plan, Pay as you earn, or PAY plan, Income-Based Repayment, or IBR plan, and then Income Contingent Repayment, or ICR plan. Now, don't worry if you don't remember all those acronyms. For most borrowers, SAVE will be the most affordable option, but we'll walk through something called our loan simulator later in the presentation, which allows you to compare all of the different options to choose the plan that works best for your financial situation. So now we're going to dive into the details of SAVE. The SAVE plan, Saving on a Valuable Education, or SAVE, replaced the revised Pay as you earn or REPAY plan. So borrowers that were historically enrolled on a REPAY plan have been automatically added to the SAVE plan and are receiving the benefits of the new plan. No further action is needed on your part if you were on REPAY. If you were not on REPAY, if you were on another repayment plan, you will have to apply for the SAVE plan, but we will get into that later on in the presentation as well. The SAVE plan, like other IDR plans, calculates monthly payment based on income and family size. It typically offers lower monthly payments compared to other IDR plans, though, because the SAVE plan decreases the monthly payments by increasing the amount of income that we're protecting, that we're exempting from our calculations. So unlike other plans, we've increased that income exemption from 150% to 225% of the poverty line. And we'll show borrower example in a minute to explain how that works. Now, you must have direct loans to enroll in SAVE. If you have Parent Plus, FEL, and Perkins loans, those are not eligible for SAVE, but we will discuss consolidation later, which allows some borrowers with these types of loans to access SAVE. Next slide, please. Now, there are so many benefits to SAVE. For most borrowers, as I mentioned, SAVE is the most affordable repayment plan yet. Many borrowers may even have a monthly payment as low as $0. In addition, the SAVE plan eliminates 100% of remaining monthly interest after you make a full scheduled payment, even if that payment is $0. This means that if you make your monthly payment as scheduled, your loan won't grow due to unpaid interest that accrued since your last payment. So for example, if $50 in interest accumulates on your loans each month, and the expected monthly payment for you is $30, the remaining $20 will be covered by the government, so it's not added to the balance the next month. Next slide. But wait, there are even more benefits to SAVE. When borrowers switch from a different IDR plan to SAVE, interest on loans won't be added to the principal balance unless you're switching from the income-based repayment plan. Spousal income is also treated differently under SAVE. So spousal income is excluded for borrowers who are married and filing their taxes separately, removing the need for spouses to co-sign that IDR application. And finally, there are even more benefits in the works. Stay tuned for additional changes to the SAVE plan later this year. As of right now, there are 7.5 million borrowers enrolled in the SAVE plan, of whom 4.3 million have a $0 payment. So if you haven't had a chance to enroll in SAVE, we really encourage you to do so. Now, like I mentioned, if you are enrolled in SAVE, your loans also might be eligible for forgiveness after as few as 10 years of monthly payments rather than 20 or 25 years under other income-driven repayment plans. Your eligibility for this shortened repayment term depends on how much you originally borrowed to attend school. That's why it's so important to enroll in SAVE. You may be able to reach forgiveness so much earlier than on other plans. And these charts here illustrate exactly how that early forgiveness breaks down. So the chart on the left shows the forgiveness timeline for borrowers with graduate loans or a mix of grad and undergrad loans. And the chart on the right shows the timeline for borrowers with undergraduate loans. So for those borrowers who borrowed less than $12,000 initially, you will reach forgiveness in just 10 years when you enroll in SAVE. And then we add the timeline, the forgiveness, a year for the forgiveness timeline for each additional amount of funding that you originally took out. Next slide, please. We also wanted to show you just how big of an impact this is having in New Jersey so far. So far, more than 4,000 New Jersey borrowers have received $35.3 million in early forgiveness through SAVE. And you can visit that link to find out the state-by-state breakdown. So I know we're getting some really great questions in the chat about the SAVE program, and we're going to have time for some more questions later, but we wanted to answer just a few common questions that we get all the time about the SAVE plan. So the first question, I know we haven't talked about the public service loan forgiveness. We're going to get to that in a bit. But if you are enrolled in the public service loan forgiveness and you're also enrolled in the SAVE plan, you might be wondering if your payments made towards the SAVE plan will still qualify towards public service loan forgiveness. And the answer is yes. Qualifying repayment plans for PSLF include all IDR plans, including the SAVE plan. Second question we get all the time is interest eliminated for all types of subsidized and unsubsidized loans, including graduate school subsidized loans. Now, technically, the interest isn't eliminated. The government actually covers the rest of the remaining interest. But in short, yes, the government covers any remaining interest for that month for any of the loans that are enrolled in SAVE, regardless of what type of loans those are. And then the last question is there an income cap for the new SAVE plan? And the answer is no. Anyone can apply for the SAVE plan. However, because it's based on income and family size, a monthly payment on SAVE might be higher for those with higher incomes. It might end up being higher than on a 10-year standard repayment plan. So we're going to talk about the loan simulator next, which is how you can compare all the different plans. So as we discussed earlier, SAVE is the most affordable option for most borrowers, but we really do recommend using the loan simulator to compare all options and choose the plan that works best for your financial situation. And I know my colleagues are dropping these links in the chat, and I really appreciate that. So you can use the loan simulator. It's accessible on studentaid.gov. And if you sign in with your FSA ID, it pulls in all of your loans and information and then allows you to compare the plan that works best for you. Once you've determined which plan works best for you, you can apply online at studentaid.gov. And we can actually go to that next slide. And when you apply online, through the new SAVE application, you can provide approval for this secure disclosure of tax information. What this means is it's allowing us to access your IRS tax return so that we can get that income and family size without you having to enter it manually, both when you apply initially, but then also yearly when you have to recertify that income-driven repayment plan. So we really recommend using that IRS module so that you don't have to remember to recertify annually. Now, if you were previously on repay or you did not provide approval for IRS disclosure when you applied for SAVE or another income-driven repayment plan, you are going to need to recertify your income on a yearly basis. Your servicer will reach out to you to remind you to do so. And the department recently extended those recertification deadlines to November 1st, 2024. Now, if you're applying to SAVE for the first time, you'll need to log into studentaid.gov to access that application, and the links are in the chat. We also have another link here that is a link to a video version of this presentation that talks through all the benefits of SAVE. So if you'd like to take a look at that, that is also here as well. Okay. Next, we're going to talk about the payment count adjustment, which is a one-time program happening right now that helps borrowers maximize their time towards forgiveness. Under this one-time revision, borrowers are going to gain credit for certain past periods of repayment, forbearance, and deferment that would otherwise not qualify towards income-driven repayment or public service loan forgiveness cancellation. This change applies to all borrowers with Department of Education held loans, including those borrowers in default and Parent Plus borrowers. For borrowers who have FFEL and Perkins loans, those borrowers need to submit a consolidation application before April 30th, 2024 in order to benefit from the adjustment. And we're going to get into that consolidation application in just a little bit. But first, we're going to dig into the details about the payment count adjustment. So basically, we're going to do a recount of everyone's past payment histories. We will count any months in repayment status, regardless of the payments made, the loan type, or the repayment plan. We'll also count any time in repayment prior to a consolidation loan on that consolidated loan. And we'll count any time in certain forbearances and deferments, which we'll get into shortly. For those borrowers with loans that have accumulated time in repayment of at least 20 or 25 years, they'll see automatic forgiveness depending on their loan type, even if they're not currently enrolled in an IDR plan. If you are enrolled in public service loan forgiveness and you get 10 years through this recount, you will also see forgiveness as well. Now, borrowers who have commercially managed FFEL loans, Perkins loans, or health education assistance or HEAL loans, or other non-direct loans, you should apply for a direct consolidation loan by April 30th, 2024 to be able to get the full benefits of the one-time payment count adjustment. And finally, we'll be refunding borrowers who made qualifying payments on direct loans that exceed forgiveness thresholds as well. Next slide. So here are the deferment. So as I mentioned, we're gonna count every repayment period, every period of repayment, regardless of the payment plan that you were on, or the payment type, or the loan type. And then we're gonna also count certain deferments and forbearances. So these are gonna be any long-term forbearances of either 12 months consecutively or 36 months cumulatively. We're also gonna count deferments before 2013, except for in-school deferments, and economic hardship deferments, which is important to note that those are different than unemployment deferments. And we will also count some military-related forbearances and deferments. After this automatic recount, we will announce a process to count some of those short-term forbearances because we know a lot of borrowers will still have those. So, in addition to non-ed held loans, we do suggest that everyone take a look at their loans. And if you have loans on different timelines, it may also benefit you to consolidate. So Perkins, commercially held FEL, health program loans, any non-direct loans, those borrowers must consolidate before April 30th to gain access to the payment count adjustment. But then for borrowers who have maybe direct loans that you took out for undergrad, and then a few years later, you went back to grad school. Those are on two different timelines, and you're gonna want to consolidate those all together so that they can be on the same timeline with the earliest repayment date. Same thing with direct and Parent Plus loans. So let's say you went to college yourself, and then you paid for a child to go to college. So now you took out Parent Plus loans. You can also consolidate those all together, and all of those loans receive that earlier timeline and get you to forgiveness sooner for all loans. The important date to remember is April 30th, 2024. That's when you want to submit that consolidation by. Thank you. So here are a few things you should know before consolidating. Your principal balance may go up. When you consolidate, your outstanding interest gets added to your principal. But if you're consolidating to get towards forgiveness sooner, this shouldn't really make a difference for you. Your new consolidation loan will also have a new interest rate. The rate could be higher or lower for some loans, but again, if you're working towards forgiveness sooner, shouldn't make a huge difference for the short term. If you consolidate by April 30th, 2024, you will not lose credit towards IDR and PSLF forgiveness. So that's so important. If you consolidate before April 30th, 2024, and you just have to submit that application, you will not lose credit towards IDR and PSLF forgiveness. Now, it's important to note that you might see initially your accounts will go to zero, but that just means that our system takes a little bit to catch up to it. And then we will update those counts, as soon as that consolidation application gets processed. And just note that consolidations can take up to 60 to 90 days. Next slide. Okay. I've been using this term a lot, public service loan forgiveness, but now we're going to talk in detail about public service loan forgiveness. So public service loan forgiveness is a forgiveness program for those borrowers who work in public service. Borrowers have to reach 4 goalposts. You have to have 120 qualifying payments or 10 years of qualifying payments on direct loans while working for a qualifying employer, and you have to have applied for public service loan forgiveness. So we're going to dig through what each of these means. To gain access to PSLF, you must have a qualifying loan type, which includes direct loans, including consolidation and Parent Plus loans. For Parent Plus loans specifically, the borrower who took out the loan, which is the parent, is eligible for that public service loan forgiveness, not the student. Now, if the student took out their own direct loans, they would be eligible for PSLF on those loans, but the Parent Plus loan is only eligible for forgiveness for the borrower itself, so the parent. Unfortunately, FEL, Perkins, and other federal private student loans are not eligible for PSLF Again, though, if you consolidate those felon Perkins before April 30th, I know I sound like a broken record, but if you consolidate them before April 30th, you will see those counts updated on those loans. Okay, so next you have to work for a qualifying employer. This means working full-time, which is 30 hours a week, or multiple part-time jobs that add up to 30 hours per week for any government or nonprofit entity. There are some very limited exceptions, but in general, the following employments do not qualify. Part-time work that does not add up to full-time, volunteer work, for-profit entities, labor unions, or contractors. So full-time, 30 hours a week or more, government, including military, and all 501c3 organizations qualifies for PSLF. Next, you have to be on one of the following repayment plans to qualify. A standard 10-year plan, any IDR plan, which is SAVE, PAY, ICR, IBR, all those ones that we mentioned earlier. And then if you're in certain periods of forbearance or deferment, those also count towards public service loan forgiveness. Borrowers who are enrolled in graduated, extended, or alternative plans do not get PSLF credit for those times. So if you are working for a 501c3 or the government and you are interested in applying for PSLF, we can go to the next slide. You can apply online with our new simplified form. You simply log in with your FSA ID, and the new form allows for digital signature. Remember that it's best to certify your employment yearly to make sure your qualifying monthly payment count remains up to date. Finally, let's say you have loans in default. You can still access SAVE through another great one-time program. So Fresh Start is a one-time temporary program that offers every federal student loan borrower a path out of default. It provides some automatic benefits, but borrowers must act before the end of September. That's our other important date, by the end of September, to claim the full benefits of Fresh Start and get out of default. Borrowers who Fresh Start their loans will see restored access to federal aid and other eligibility for other government loans as well. Collections will also stop, which allows for restoration of credit reporting or changes to your credit report after those collections stop. Fresh Start also preserves the date of first delinquency, and which means that if your defaulted loans get wiped off of your credit report after 7 years, so if you've been in default for 7 or more years, we're going to preserve that date of first delinquency, and then you'd be eligible for that that wiping of the default on the credit report. And Fresh Start also allows borrowers to gain access to IDR plans, including SAVE, loan forgiveness programs, and short-term relief options like forbearance and deferment. There are multiple ways to sign up for Fresh Start. Next slide. You can sign up via phone, online, or by mail. But borrowers must sign up before September 30th, 2024. Okay, so we wanted to share contact information for any follow-up questions. I know my colleagues have been answering your questions diligently in the chat, but if you have other questions, you can always start with studentaid.gov. Huge lot of information there. If you need help with your personal loans, you can email our team at the Ombudsman's office. Our email is provided here, our stakeholder engagement team. If you're looking for more holistic financial coaching, you can reach out to New Jersey Citizen Action for personalized financial coaching. And with that in mind, I'm going to welcome Paula Merck, who is the Director of Financial Coaching at New Jersey Citizen Action, and she's going to talk about that.
Hi, great. Thank you, Rachel. You give me so much energy. Thank you so much for going over all the many options that you folks have made possible for so many student borrowers. Like I said before the webinar started, we've had some great luck with helping people through their student loans and the best options for them at our financial coaching project. So for those of you who don't know about that, please consider connecting with financial coaching. If you still have questions after the webinar, We do a lot of one-on-one work with folks to help them get out from under their student loans. Often a barrier. We just had a client last week who has gotten all of her debt forgiven, over $300,000 in student debt. And now she's got a very different credit picture, and she's able to think about moving forward with her bigger goals of buying a home and things like that. Now I'm going to ask Kaylin from FSA to join us, and Margo come back so that we can start thinking about some of the questions that have come up. We have quite a few different types of questions to field, and I think I should just open it up to all of you. I know there were some that you were going to take on and use this time to think about. I will mention, I've been kind of keeping an eye on the questions, things like a 32-year-old student loan. Yep, I bet there's something we can do about that. Questions about if you're in Parent Plus, can you still, yes, I think we can do something about that. But I would say the main thing is that April 30th deadline, let's get as many people consolidated as possible so we can get moving with things like SAVE. So please do contact us so we can provide the one-on-one free support for you to figure out your student aid questions.
Thank you so much, Paula. Yes, we had some great questions submitted, and I am going to kick us off with our first question. And someone had asked, how do I manage student loans living paycheck to paycheck?
Thank you, Kaylin. And this is such a great question, and one we receive all the time. We've recognized that so many people in this country are living paycheck to paycheck. And we discussed a bunch of different types of income-driven repayment plans, which, as a reminder, set your payments based on your income and your family size, not the loan balance. So that means that payments will reflect your actual financial situation rather than your loan balance. So the good news is that SAVE, that plan we talked about today, is designed to be the most affordable income-driven repayment plan yet. If you're making $15 an hour and living paycheck to paycheck, your payment will actually be $0 per month. That $0 payment will still count towards forgiveness, though, over the long term. So we encourage everyone to utilize the tools mentioned and that were dropped in the chat: the loan simulator, the IDR application, and also New Jersey Citizen Actions, financial coaching as well, to find the most affordable plans that are best for your financial goals and circumstances.
Absolutely. Thank you, Rachel. Another topic we get a lot of questions about in general, and then also from today's participants, is about consolidation. And so this question is, if I consolidate, will my time towards forgiveness on an income-driven repayment plan or public service loan forgiveness start over?
So that's the great thing about the payment count adjustment that's happening right now. They will not start over, but only if you submit that consolidation application before April 30th, 2024, like Paula just mentioned. We do want to flag, and I mentioned this briefly, we do want to flag while or immediately following submitting the consolidation application, there might be a brief period where your loan looks like the time in repayment is 0 months. This is not the case. It just takes our systems a bit to catch up after you originate a new loan. Rest assured that through the payment count adjustment, FSA will carry over all of your time in repayment from your underlying loans to that new consolidation loan if you submit that consolidation application by April 30th, 2024.
We're going to keep repeating that date over and over again. So our next question has to do with payment amounts. And so it's on, if I qualify for SAVE and my monthly payments have been reduced to a $0 payment, how will payments count towards loan forgiveness?
That's the awesome thing about SAVE, is that any payments, even if you're not making a payment, even if that monthly payment amount is $0, that will count towards both public service loan forgiveness and income-driven repayment forgiveness as well. Plus, when you're enrolled in SAVE, you may reach forgiveness in as early as 10 years if you had a low initial balance.
Can I ask
Yeah.
a quick follow-on about that, Rachel?
Yeah.
Because I have many clients that have this question. If you have public service loan forgiveness and you missed that window where you got credit for past work experience, when you get into SAVE, do you get credit for past work experience if you were paying on your student loans back then?
Yeah, so I think what you're asking about is the public service loan forgiveness waiver, which ended in 2022. And so what we did was we took the public service loan forgiveness waiver, which was just for those public service loan forgiveness borrowers. We broadened it even further, recognizing kind of the failures in the programs throughout the years, and made it even broader through that payment count adjustment that's happening right now. And so what that's doing is for all borrowers with direct loans, whether they be on public service loan forgiveness or not, whether you had been on an IDR plan or not, we're going to look back and recount your times in repayment. And then we're also going to look back and recount or count certain forbearances, those long-term forbearances, 12 months or more, 30 or consecutively 36 months cumulatively. We're going to count all of that towards repayment to get you to forgiveness sooner than otherwise. So it's kind of like a second chance for those borrowers who may not have been able to take advantage of that public service loan forgiveness waiver.
Great, thank you. Thanks, Kayleen. Sorry to jump in. It's just a burning question we have all the time. I appreciate
It's
it.
an excellent
Excuse me,
question.
Sure. I don't want to interrupt. I just want to could people put their questions in the Q&A section that we'll get to the questions faster. Thank you so much.
Thank you so much, Beverly.
Thank you, Beverly. So we're talking about consolidation in this webinar. We've talked about different types of loans and qualifying loans for these programs. And so where can borrowers find out what types of loans they have?
Great question. So your loans are located on your studentaid.gov dashboard. You can log in with your FSA ID. Keywords to look for are direct. Those are those loans that qualify for all these programs, regardless of, you don't need to consolidate necessarily. And then FEL and Perkins. Another type of loan that we've talked about a little bit is Parent Plus loans. And so those are kind of the different types of loans that you might see on your studentaid.gov dashboard. You can also call 1-800-4-FED-AID, and one of our agents will be able to help you as well.
Absolutely. And so Paula jumped in with a question on the payment count adjustment. I want to piggyback off that question and go to our next one that has to do with the repayment plan and how that works with the adjustment. So Rachel, do I have to be on an income-driven repayment plan to receive the payment count adjustment? I have been in repayment, but not on that plan.
That is one of the best things about the payment count adjustment. You do not have to have been on an income-driven repayment plan prior to the adjustment to get that income-driven repayment forgiveness after 20 or 25 years. So, and as I mentioned earlier, it's a little bit complicated, but we're going to go through and count all the time in repayment, no matter what plan you were on, plus the time that you were steered into a long-term forbearance by your previous servicer. And we'll count some deferments as well. If all of that credit gets you over the finish line, which is 20 years for undergrad loans and 25 years for grad loans, we'll give you automatic forgiveness. If that credit does not get you over that finish line for loan forgiveness, either through the income-driven repayment forgiveness or public service loan forgiveness, we encourage you to enroll in income-driven repayment plan for that IDR forgiveness moving forward, so you can continue to receive credit towards IDR forgiveness after the payment count adjustment.
Thank you so much. And some other questions about time periods in repayment and working when going towards public service loan forgiveness. Someone asked, how long do you have to work at a nonprofit or for the government before debt is cleared?
So to earn, we go by payments, but I'll turn the payments into years for you. So to earn public service loan forgiveness, you need to make 120 payments while working at a public service job. That includes most nonprofit and government work, and 120 payments or months generally works out to 10 years. But keep in mind that the payments and work history don't have to be consecutive. So you can take breaks if you work at a public service loan forgiveness or qualifying employer, take a couple years off and go back. As long as it ends up to 120 months at the end, you will reach forgiveness. And don't forget that the past 3 years, while we were under the CARES Act payment pause, though that time will count towards PSLF as long as you were employed. These months will also count towards income-driven repayment loan forgiveness as well.
Wonderful. We have a couple of more questions, and one of them is about loan type and clarifying a little bit more around Parent Plus loans. So I am a parent. I am pursuing PSLF. Can I use my PSLF to pay off or get forgiveness on my child's debt that they took out?
Yeah. So unfortunately for public service loan forgiveness, it is for whoever the borrower that the loans are in, the name of the borrower that the loans are taken out in. So for regular direct loans, that's the borrower, right? But for Parent Plus loans, it's the parent, because the parent took out the original loan. That's who qualifies for public service loan forgiveness. So if you are a parent and you have your own loans and public and Parent Plus loans, all of those would get wiped out under public service loan forgiveness. But unfortunately, you can't transfer loans between a child and a parent. And so the child would have to work in a public service or a qualifying employer for 120 months as well to get their own debt cleared as well.
Thank you for clarifying that. I know that can be confusing for a lot of borrowers. Another question on PSLF. I do think we only have one more following this one. I have been employed at a qualifying employer and making payments, but I don't know if one of my loans that I pay on is a direct loan. Do I still have time to make sure that loan will get credit?
You're just trying to end on that April 30th date. So this is that payment count adjustment that you have to consolidate your loans by April 30th. So if you had some direct loans and some FEL loans, or if you just had FEL loans and you've been at a qualifying employer, you can apply for PSLF and for that time that you've had, and you can consolidate your loans by April 30th, 2024, next month, and you can get all of that past credit regardless if those loans were qualifying or not. So the two takeaways from today are check to see if you need to consolidate by April 30th, 2024, and enroll and save as well.
Yeah. And two ways to check, Rachel, just for those who are on the call. You can check by going to studentaid.gov, and you can look at what the status is of the different loans that you have. Also, if you see a credit report and you see a variety or a bunch of different loans on there that are student loans, it's a good chance it hasn't been consolidated, right?
Yeah, if you have different times, the things you're looking for is a direct consolidation loan. That's what the consolidated loan will look like. If you have different types of loans, that's a good indicator that you're going to need to consolidate. The other thing is if you have different loans on different timelines. So that's like if you took out loans for undergrad and then a grad program, or if you took out loans for yourself and then Parent Plus loans for a child. So different timelines or different types of loans are going to be good indicators that you're going to need to consolidate your loans.
Just to make it clear, you can contact us at financial aid at New Jersey Citizen Action. You qualify if you make less than $100,000 a year, which is most of us, and it's free one-on-one. So if you have a question about your student loans, even if you don't want a full-blown financial coaching process, give us a call and we can help you figure and sort those things out, and do it before April 30th.
I love ending on that date, Paula. I love ending on that date. Thank you all who submitted questions. And again, just echoing Paula, if you have additional questions that you didn't get to ask in today's webinar, please feel free to contact us. And with that, will kick it back over to Beverly.
Thank you all so much. There is so much information that people need, and you've all provided so much of that information. I think it's important that everyone who participated today know that these are the experts and people who can help you navigate your loans. And so the contact information that we provided for them is really important. As Paula said, we do have the one-on-one coaching program at Citizen Action. It's free. You should take advantage of that, at least to get you started. And then if you have more specific questions for HESAA or for FSA, Federal Student Loan Aid, or sorry, Federal Student Aid, you can contact the agencies that have been represented today. I did want to make one comment. There was a question about what can students do who are in school now who haven't finished yet. And this information is, of course, for people who have started to pay back, they've finished their programs and they've started to pay back their loans. Some of you are going to go on to graduate school, so you may be in graduate school, but you've got other loans to deal with. But also, I think what's really important is for you to know that this information is going to be available to you, and that right now there are programs available for when you do finish. But you want to start to understand these different programs so that when you get out of school and start to pay back your loans, you know exactly the right program to get into. There may be some changes along the way before you get out, but these are the agencies that can tell you what those changes are. And it's really important that you know immediately when you start paying, what is the pathway to paying down your debt efficiently, to paying down your debt in a way that you don't incur more debt. And of course, to take advantage of any of the forgiveness programs that are available. If you're doing public service, you want to make sure that you find out whether your employer is eligible and that you are enrolled in that program as quickly as possible if you're doing public service work. I think Margo started the program by saying, for those of you who are going to school, just about to go to school, or if you have children or friends that are going to start school, look at the ways to avoid the debt to begin with. In New Jersey, we have some great programs to help many students even go to college for free. But it's really important that I just keep saying this, but the people who are on who haven't finished school yet, you want to know this information anyway. You really need to know it. And then Paula's program helps with other things besides student debt, and you can get in there and learn how to manage your finances in general. And then you'll have a head start in terms of dealing with your financial debt from student loans. So with that, I think we're going to end. I think everybody's contact information is in the chat. You can always contact Citizen Action for more information. But thank you all for participating. We hope that you'll share. We're going to have this recorded. I think we'll have it online, and I hope you'll share it with friends and family because the information is so important. So thanks, everybody. Have a good evening. And we'll do this again. We're going to have to do it again, maybe in the fall. But thank you so much, everybody. Have a good night.